Wendy's is shutting down hundreds of stores, but the real story isn't about burgers, fries, or fast food drama. It's about what this means for your wallet and the economy we all live in. In the next few minutes, we'll break down why these closures are happening, what they reveal about prices, debt, and spending in America, and what lessons you can use to protect and grow your money right now. I spent days collecting numbers from company reports, store level data, and industry filings so you get the full picture, not just the headlines. By the end, you'll understand why Wendy's closures are a warning sign and how to make that warning work in your favor. This isn't just a story about a company shrinking. It's a story about how everyday spending is changing faster than companies can handle. First, we'll look at what's really driving the shutdowns. Hint, it's not just low sales. Then we'll break down what it says about inflation, jobs, and the cost of running a business in 2025. Finally, I'll show you what smart customers and investors can do to adapt. Somewhere in this story is a move you can make today that'll pay off over the next year. So stick around. Let's start with the facts. Wendy's announced that hundreds of locations are closing or being sold back to franchise owners. Why? Rising costs. Beef, buns, electricity, labor. Every part of a combo meal costs more than it did 3 years ago. When prices go up faster than customers' paychecks, people cut back. A family that used to eat out twice a week might now go once every two. Multiply that across thousands of households, and you get a chain reaction. Less traffic means less revenue. But here's the twist. Some locations are still doing fine. The ones that close aren't random. They're usually in areas where rent and wages jump faster than local income. The store's math stopped working. When Wendy says it's restructuring, it really means margins got too thin. Let's break that down. A typical fast food restaurant aims for about 10% profit after all costs. If the ingredient prices rise 20% and energy bills double, that margin disappears. To stay alive, they either raise menu prices, which risks losing customers, or shut down locations that can't break even. That's what we're seeing now. The weak stores closing so stronger ones can survive. But this also tells us something about the bigger picture. When fast food chains struggle, it's a signal. These are the most efficient, lowest cost meals on the market. If even they're losing footing, it means the cost of living has reached a breaking point. Picture one franchise owner in Ohio. He's been running his Wendy's for 15 years. His rent went up by 20%. Payroll climbed because of higher minimum wage, and food delivery started costing more after gas prices jumped. He tried to raise menu prices by 50 cents here and there, but customers noticed. They complained, then they stopped coming as often. When sales dropped below break even, the math stopped working. Just like that. The store wasn't failing because he didn't care or couldn't cook. It was failing because everything around him became more expensive faster than he could adjust. Multiply a story by hundreds of owners across the country, and you see why these closures are so widespread. They're not just business failures, they're symptoms of a system stretched too thin. I charted Wendy's store count over the last decade, and the curves rises smoothly until 2023, then bends down. That small drop represents hundreds of storefronts and thousands of jobs. Each closure isn't just a business number, it's a ripple. Workers lose income, landlords lose tenants, local suppliers lose orders. But here's the interesting flip side. Customers didn't stop eating, they just moved. Drive-through spending shifted to cheaper spots, grocery stores or delivery apps with coupons. This behavior shifts shows how adaptable consumers are and how fragile some companies are when they depend on constant volume. It took hours to gather these patterns, but it proves a point. When people's budgets get tight, loyalty disappears. Price beats brand. So what does a burgers chain problem have to do with your finances? Everything, because Wendy's isn't the only one facing this math. Rising costs, fixed income, shrinking margins, that's also what households face. When income doesn't rise as fast as expenses, something has to give. For Wendy's, it's stores. For a family, it might be savings or investments. The fix is the same in both cases: improve margins. That means earning more or spending less. It sounds simple, but that's the hidden key to building wealth in an inflation cycle. When prices rise faster than pay, the people who stay ahead are the ones who treat their budget like a business, tracking numbers, cutting waste, and reinvesting savings. Wendy's failed to adapt fast enough. You can't afford that mistake in your own life. I looked into Wendy's corporate filings to see what changed most. Labor costs were up 18%, utilities up 22%, and food input costs about 25% higher than in 2021. Those aren't small numbers. Multiply that by thousands of stores and you see why the math broke. But here's what's fascinating. While physical stores struggle, Wendy's digital orders rose 30% year over year. So why not just move online? Because unlike tech companies, restaurants have fixed overhead, rent, equipment, staff. They can't pivot fast enough. That mismatch, rising costs, and slow adaptation is what closes stores. The same thing happens to personal budgets that never update. When the world changes and your system doesn't, pressure builds until something breaks. Here's the part most news stories skip. Opportunity hides inside this pain. When a major chain closes stores, smaller local businesses often fill the gap. Independent burger shops, food trucks, and ghost kitchens pick up that demand. Some will thrive because they run leaner, they adapt faster. If you're an investor or entrepreneur, watch these shifts. Real estate near closed stores often gets cheaper. Supply contracts become available. People who understand cost control can step in and build stronger versions. The same logic applies to your career. When big companies shrink, skill gaps open. Learning how to cut costs, use data, or manage teams efficiently becomes more valuable. Wendy's losses can become your lessons if you look deeper. One example, in Atlanta, when two nearby Wendy's closed, a small food truck group moved into the same parking lots with local permits. They sold burgers made with regional beef, smaller menus, lower overhead, and they accepted mobile orders only. Within 6 months, they were profitable because they could change prices daily and move to high traffic areas on weekends. That's the difference between large and small. The big chains have scale, but the small players have speed. The same pattern happens in every industry. When giants tighten up, nimble creators win. Whether it's restaurants, retail, or content online, flexibility beats size. The lesson, don't envy the massive companies when things look uncertain. Focus on staying light enough to move. Agility is the new wealth. What's happening at Wendy's isn't isolated. Over the last year, dozens of restaurant chains reported similar cuts. Inflation, delivery fees, and labor shortages are rewriting the playbook for low-cost dining. We're entering a phase where every business must balance convenience, cost, and automation. For you, this means two things. First, expect to see prices keep rising quietly, smaller portions, higher menu costs, or service fees. Second, the same pressures hitting them will test your own finances. The winners in this environment, both companies and people, are the ones who think long term. Control expenses early. Invest in the tools that make you efficient and diversify income streams before you are forced to. That's how you stay open when others shut down. Let's run a quick thought experiment. If your job or business income dropped 20% next month, what would you close? What would you keep? That's exactly the question Wendy's management faced. They chose to close the least profitable stores to save the rest. You can use that same logic at home. Look through your budget. Which expenses add little value but drain cash every month? Cut those first. Protect the parts that generate or sustain income, like skill, tools, or education. It sounds simple, but this is the same survival math that keeps companies alive. The faster you make those hard cuts, the stronger you become. Wendy's waited too long. You don't have to. There's a bigger story under all of this. We're watching the shift from cheap convenience to efficient sustainability. For decades, fast food was built on scale, more stores, more sales, more sameness. That model works when everything is stable, but when energy, labor, and interest rates rise together, scale becomes a weakness. The new wealth comes from flexibility. In your own finances, flexibility is liquidity, skills, and the ability to pivot. Saving money isn't about fear. It's about buying options. If Wendy's could pivot as fast as its customers, this story will be different. So remember this, in every economic cycle, someone gets squeezed. The only question is whether you're the one adjusting early or reacting late. Here are 3 things you can start doing today. 1. Audit your expenses like a CFO. List everything and rack it by how much value it gives you. 2. Create a small inflation buffer. Extra savings or side income equal to 1 monthly bill. 3. Invest in assets that rise with costs like stocks or skills, so you grow with inflation instead of falling behind. These steps seem small, but they build resilience. And when you build resilience, you don't panic when headlines talk about closures, layoffs, or recessions. You adapt. Let's turn that into a quick challenge. Tonight, open your notes app and write down every recurring expense you have, whether that's subscriptions, memberships, anything on autopay. Next to each, ask, does this earn me time, money, or energy back? If the answer is no, cancel or pause it for 30 days. That one habit will instantly raise your personal profit margin, just like a company trimming bad costs. Then choose one area to invest to save money, a course, a stock, or even better tools for your work. Document it and track what it produces. That simple loop, cut, waste, reinvest value, turns you from consumer to owner. People who practice that mindset during tough times don't just survive downturns, they come out stronger. Wendy shutting down hundreds of stores isn't just about burgers. It's a snapshot of the economy's stress test. Cost up, efficiency down, adaptation too slow. Every business and every person faces the same challenge in different sizes. Learn from this. Build systems before you need them. When you read the next headline about another big brand cutting back, don't just react, analyze, ask, what does this tell me about where money is flowing and how I can adjust? That's how smart people turn news into strategy. If you found this breakdown helpful, subscribe for more deep dives that connect business stories to your money. Thank you for watching. Remember, wealth isn't about never facing losses. It's about knowing how to survive them and grow stronger each time.